In this section, we're going to do an introduction to financial charts. So as I alluded to in the introduction to the course, we're going to assume that a lot of people who are checking this out have very little experience with charts or technical analysis. So in order to establish that foundation, we really need to start right at zero. And that is going to be the construction of a chart and the elements of a chart. And then we can understand how we use those charts to our advantage. So in this section, we're going to cover chart basics. We're going to look at a few different types of charts, scales and time frames. We're going to be talking about price and time series data, and ultimately how we're going to interpret that data and how the price action of the market manifests itself in a visual format that is our chart system. So let's start at zero. If you went to elementary school or basically just existed in Western society, you no doubt have come into contact with a graph very similar to this. All graphs have two basic elements, an X and a Y coordinate. Y goes up and down, X goes across the bottom, and they represent different things. In this case, Y is the points scored, X is which team, and then we plot the points per period on our graph to give us a very nice visual representation. So, like I said, all charts basically follow this format with some minor changes. And one of the minor changes that we see in a financial chart is a shift of our Y coordinate to the right-hand side. Now in this case, we have a ticker on the top, we've got price on the right, and on the bottom, we still have teams. But in order to convert this to an actual financial line chart, we need to make one more change, and that is converting the X coordinate from being representative of teams to being representative of time. Now in a line chart, which is what we're looking at here, the up and down coordinate is our price. We see prices increasing as it moves up, and then we see time along the right. So for every point or period of time, we have a single price point that reflects the price at that moment. If this is a daily chart and this is a current day, today's closing price for Google or GOOGL is $1,213.23. Tomorrow, whatever the price ends up at, we will see this line change. If the price increases to $12.20, we will see the price line right where my cursor is. Those are the fundamental aspects of charts that we use for financial trading. Time is on the bottom, price is on the right. So in the last screen, we introduced the concept of a line chart. And a line chart is probably the most common financial chart that you will run into. It represents a single point of price and a single point of time, and the periods can be anything from minutes to hours to months. It doesn't really matter. All we know is we get a single line representative of a price at a certain point of time. And these types of charts are useful because they can convey basic trends, they can show us support and resistance levels, they can show us some patterns. For example, we can see a trend here. There's a downtrend. We're setting these consistent lower highs and lower lows, so we know we're in a downtrend. We can see that there are support and resistance levels where we turned around down here. We hit a resistance and pulled back from it. And we can see that there are indeed patterns. We get a nice EQ building here. We break that level of key support and then continue a downtrend. So there's a lot of information you can get from a line chart, but primarily they are simple means to show simple prices over time. For trading, they are not particularly useful, and we can get more data out of bar charts and candlestick charts. So let's look at a bar chart. A bar chart expands on the concept of the line chart by presenting a few more pieces of information. First of all, each of these lines is representative of a single period of time. It can be a 5-minute period, it can be an hour, it can be a month. Whatever period you're looking at, if it's a daily chart, 5-minute chart, 15-minute chart, that tells you that each bar represents X amount of time. There are segmented periods that show you the price action in a given range over a given time. Now, what's cool about bar charts is they show you the price at the beginning, the price at the end, and the full range of the price during that time period. So in the very first example, we can see that the price started right where my cursor is. We entered the bar, we dropped down to our low, we got all the way up to the high point before pulling back slightly, and at the end of that period, we ended the price at this point, started the next price at this point. Generally, these will line up with each other, but in the case of markets, like the regular stock market, that ends at 4 o'clock, sometimes the price can open at a different price than it closed on the previous day. So we can have a closing price and an opening price in the next candle that don't necessarily line up. Just like line charts, these prices can convey trends. So we can see we're in a downtrend on this chart. We see support and resistance levels. We can see patterns. It's a very nice representation that expands on the line chart by having the entry, the exit, and the high and the low. Another way to show this information is through the candlestick chart. And the candlestick chart is the most common chart that we are going to use throughout almost all of our trading. It is a very visually appealing representation of price data, just like bar charts. Each candle, as we call them, or bar here, represents a segmented period of time. Again, it can be 5 minutes, it can be an hour. It doesn't really matter. This is 5 minutes, this is 5 minutes. Whatever time period we are in, that single candlestick represents the totality of all price action in that given time period. Just like a bar chart, it shows you the opening price and the closing price, the high and the low. On a green candlestick, you see the opening price on the bottom, the closing price on the top. On a red, it's just the opposite. We have the opening price on the top and the closing price on the bottom. The full range is shown by these two lines. These are called the wicks on the upper and bottom of the candlestick. And candlestick charts are amazing because they represent psychological markers that are happening in the market. We can use them to quickly identify trends and support and resistances, just like we can do with our bar charts, but we also have the ability to see underlying psychological markers inside a candlestick. For example, we see a small body in this green candlestick with a long lower wick, which shows us a big bear attack. This is called a hanging man candlestick. It is representative of a reversal. On the next candlestick, we see an upper and lower wick, which indicates indecision, and we have a reversal signal followed by our indecision signal that results in a change of the trend. These are one of the many ways that we can use candlesticks and candlestick charts to inform our technical analysis and our analysis of the overall market. So incredibly valuable, a great way to read the market, and we will be using candlestick charts for almost all of our courses from this point forward. So we've already talked about candlestick shapes a little bit. I want to get into some more detail and look at the actual construction. For people who have never been trading before, this can be a little bit confusing. So let's start at the very basics. There are 5 elements to a candlestick. There's an opening price, a closing price, a high-low, and a color. The color tells you the direction of the price in a specific candle. If we have a green candlestick, it means that our opening price is lower than our closing price, in that we gained money during this period. If we open at $20 and we're green, it means we're going to close at above $20. If we are red, it means that we have a ending price that is lower than our opening price. Now going back to our green candlestick here, we can see that we have 2 things going on. We have a large rectangular shape, and we have 2 small lines coming out of the top and bottom of our candlestick. With a green candle, we open at the bottom of the rectangular shape, which is also called the body, and we see the closing price is the top of our body. But we also see that we have extreme ranges on either side, and those are indicative of the highest price and the lowest price in a given period. So here's our green candlestick. We see the opening price. Our price drops down to this level before regaining strength, moving all the way up to the extreme range at the high price, and then ultimately closing at the top of our body. Candles are units of time. So we have mentioned that you have monthly, weekly, 5-minute, 2-minute, even 1-minute charts, all using candlesticks that look very, very similar to each other. That is because candlesticks can be representative of almost any unit of time. Now, the shape of these candlesticks represents the movement of price inside that candlestick. Now, if you recall in the last slide, we saw the opening close and the high and low range. Each of these candlesticks has all of that information contained with it. In the case of our first red candlestick, our high and our opening price are the same. Our close and our lowest price are the same, so there are no lower wicks. On the candlestick just to its right, we see a small green body with a long upper wick and a long lower wick indicative of volatility. So we can tell just by looking at these 2 candles who controlled the narrative of this trading action. In this case, it's the bears completely dominating all the action. Here we see volatility, and a long green wick, which shows us that the bulls were in complete control of this particular candlestick. It's also very important to understand the psychology that happens behind these candlesticks and how they can inform your trade decisions. Over here in this example, we see another small body with a long lower wick. And in this case, this is a reversal signal at the top of our uptrend, which tells us that the bulls are losing the ability to keep pushing the price higher. In fact, we see an attack by the bears flushing the price down, and even though the price did recover, we see indecision in the next day represented by tight body and upper and lower wick, which results in a change of trend to the downside. So there's a lot of information packed into each of these individual candles. And beyond what we see at face value, each candle is also representative of the information and the price action that is contained inside it. So as we mentioned, if these are 60-minute candles, that means we have 4 15-minute candles or 6 10-minute candles, and you can just keep chopping it up into smaller and smaller pieces of time, all represented by candlesticks. So let's expand on that a little bit and look at time frames. So here we are looking at the same chart in different time frames. A 5-minute chart, we can see that we start off with a nice green candlestick, but we have profit taking. We need to be cautious about what's happening there. We open inside the range of our previous candlestick, but we start dumping, and we go all the way down before seeing a nice bounce. So 5, 10, 15-minute candlesticks. These 3 candlesticks are then combined to create our first 15-minute candlestick. So all of the trading range and action that you see in these 3 candlesticks is combined into this big candlestick, and this is representative of those 3. I know I'm repeating myself here, but I really need to drive home the fact that you can contain sub-time frame information in a larger time frame's single candlestick. And just like we see these 3 candlesticks fitting into this guy, this 15-minute, half-hour, 45, 60-minute candlestick, all of these are combined into one 60-minute candle. So now that you understand how candles are constructed and how they're used and what a basic chart looks like, we can start looking at a few of the ways that we use both candles and collections of candles to tell us what's going on in the market. And a lot of that is done through trend analysis and pattern analysis. And we're going to get into the very, very basics of those two things now. So now that we've reviewed basic candlesticks, we have an idea of what each candlestick represents and how the time frames work. We can start using collections of candlesticks to look at overall market movements. And there are 2 main things that we use for trading. One is going to be the trend, 2 is going to be a pattern. So we're going to start with trends. And what are trends? Well, really, they're directional price movements that remain in place long enough for you to be able to recognize them and for you to act upon them. In the case of our trend here, we can see that we are setting lower highs and lower lows. We're generally moving to the downside. So what you can do is say, look, we're in a trend. I know that we are setting lower highs, so I'm going to jump on this lower high with the expectation that the trend is going to continue and the price is going to move down. And that is the most basic concept of trend trading. We look for uptrends, we look for downtrends, and we trade inside those. So there are a few different types of trends. An uptrend, and that is where we set higher highs and higher lows. Or we have a downtrend like we see here, where we set lower highs and lower lows consistently, moving the overall price action to the downside. We also have sideways trends, where we trade inside a sideways channel with no higher highs or lower lows. And all of these trends, up, down, sideways, all reveal different support and resistance levels that we can mark up and use for our benefit. And it looks something like this. We can see that we have our high, our resistance, we have a resistance again, and another one. So we can use these trend lines to look and say, yep, we are getting close to this resistance level that has proven itself to be an effective barrier to price action, and I'm going to take a short position against this trend. Inversely, you can also use the support levels. We come down and consistently grind against this area of support. So what you can do is say, yep, we are near an area of support. I'm going to enter a long position because I believe this support will hold, and I will exit at the top of my trend. Being able to recognize trends is the most critical aspect of profitable trading. Nothing else comes close to the importance of being able to recognize trends, act on trends, and recognize trend changes. Second to trends, we have patterns. And patterns are beautiful. They are prices that are combined by support and resistance. And what's most important about these is that they really represent market psychology. They're repetitive. They happen over and over again across all time frames. You can focus exclusively on several types of patterns. You can play bull flags only, wedges only. They all represent different things inside the market. They're all driven by emotion and psychology, and they can all be incredibly useful. They are confined trading ranges. They have support and resistance levels like we see here. They're influenced by emotion and market psychology, as I just mentioned. They're fractal and repetitive. They work on any time frame, monthly, weekly, 5 minutes, it doesn't matter. And they have clear levels of breakout and support and resistance that can give you actionable signals. In the case of this guy, we have a beautiful pennant. We have multiple areas of resistance, multiple areas of support, and we have a beautiful break above that level, a quick back test, and then full execution. So patterns and trends are the two elements that you need to absolutely understand and appreciate the power of, but also be able to recognize and utilize in your own trading.